Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll discuss President Trump's latest commentary around trade negotiations with China and the back and forth. And the trade war upping the odds of a recession, according to a number of experts. We'll discuss what a potential slowdown could mean for the tech sector. And recession-proof stocks for your portfolio. One analyst sharing two names that could potentially weather a downturn. That and more on Catalyst. Half an hour into the start of U.S. trading, let's get you a check on the markets here. Taking a look at the major averages, a little bit of a bounce back in your tech-heavy NASDAQ here. It's up 0.1%. Your S&P 500 still down about 0.1% as well. Let's flip the board over to the bond market here. Taking a look at yields coming in just a bit. And this is actually the second week in a row where we are on track for yields to be coming down. So yields sort of doing what they are supposed to do, acting as that risk-off sentiment trade. You got your 10-year down about 2 basis points, your 30-year down 3 basis points here. Finally, though, let's take a look over at Bitcoin. It is up this morning, holding above that 94,000 level. It is up over 1.75%. Well, University of Michigan consumer sentiment data is crossing the wire here. Let me get you those numbers coming in here. So University of Michigan one-year inflation expectations just a tick below the prior result, but still coming in at 6.5%. That is a touch below the survey estimate of 6.8%. 5 to 10-year inflation expectations coming bang in line at 4%. That is the same number we got in the prior print and in line with the survey data as well. Expectations coming in just a bit hot at 47.3. The overall number coming in at 52.2. Current conditions coming in a bit above expectations as well, coming in at 59.8. But what we have been keenly watching here at Yahoo Finance is those inflation expectations as an indicator of where consumers see this economy heading. Those inflation expectations, again, for the year ahead coming in at 6.5%, just a tick below the survey expectation of 6.8%. Our very own Josh Schafer is with me on set to break down the numbers. Josh, what's your takeaway from this?
I think so, Maddie. The thing about this release is, of course, you have a preliminary reading, which we got 2 weeks ago, and then you have the final reading. And given the tariff back and forth that we live in these days, what you're seeing in a couple of those numbers you were just listing is the final reading happened after April 9th, after the 90-day pause. So what you saw is consumer expectations for inflation come down slightly, right? You're looking at a number, I think it's 6.5% for the next year. That is down again slightly from the 6.7 you saw before, still well above the 5% you saw in March, and still the highest reading since 1981. So net, okay, the tariff pause helped consumers feel a little bit better about the picture, I think is sort of the takeaway here, but going through the release, you still have consumers feeling pretty grim about the overall economic outlook, about the labor market outlook. There's been expectations for unemployment have been their highest since 2008 or 2009, pretty consistently in this release for about a month now. That's continuing. So I wouldn't say April 9 really cleared all of those concerns that consumers seem to have, but I guess a little bit better than the initial reading, which came right after Liberation Day on April 2nd, and I think there was perhaps more of a shock factor in that one.
And I think, it's obviously a consumer sentiment survey. This is not hard data, quote unquote, but 6.5% inflation, certainly keenly above the Fed's desired 2% level. And I'm curious, Josh, how this might be playing into any of the other expectations that you're hearing from analysts on the street just about where the economy is heading.
Yes, I've been asking economists essentially, okay, we're talking about a potential slowdown, right? I think that's basically consensus at this point. Perhaps the debate is how much we're going to slow down, but when are we going to start seeing that in the data? And largely what economists have argued is it's probably a summer cool down, summer slow down environment that we're going to see. So what you're seeing right now, again, April is sort of when most of the tariffs hit. You don't get the April quote unquote hard data. That means maybe your unemployment rate, maybe consumer spending, maybe goods orders. You're not going to see that until May. And then May might have some interesting numbers too, because again, we've sort of been going back and forth on tariffs. They think we're going to get a clearer picture by the time we maybe hit June. So the data from May, you start to see in June. Then do you see a slowdown? And then the interesting part of all of that being the labor market still usually lags, right? So the way this sort of works is if I'm a business, first I need consumers to slow down so my business slows down. Then I need to think about how I'm going to cut costs. Then at some point it leads to me lowering headcount. Headcount usually comes a little bit later. So in terms of initial jobless claims, in terms of that unemployment rate, in terms of non-farm payrolls, we have a jobs report coming next week. not a lot of expectations for that outlook to get too cold until, again, perhaps even later in the summer into the fall. So it seems like we're talking a lot about bad survey data right now. It's going to take a while to figure out how bad the actual data is going to be.
And that's why the Fed is perhaps in no rush to cut, though if you listen to Fed speakers this week, maybe they'll cut as early as June, but it would take that hard data for that to happen. One really quick thing from the UMich report here, talking about how even more concerning for the path of the economy is consumers anticipating weaker income growth. If we do see that weaker income growth, does that lead to a little bit of a slowdown in spending moving forward? Josh, thank you so much. Really appreciate it. Well, China is considering exemptions from its 125% tariffs for some U.S. goods, according to Bloomberg, as tensions between the two nations weigh on certain industries. Messaging on trade negotiations has been mixed, as the president says talks are underway. Beijing saying they're not. The volatility playing out in markets as investors seek safety outside of the states. Here to discuss those opportunities with us, we've got Guy Valle. He is ABS Global Investments founder and emerging markets portfolio manager. Guy, great to have you here. I do want to have you put on your geopolitics cap for me for a second. China continuing every morning when I wake up, they're denying the negotiations that the president said that we were having when I fell asleep. But the president also this morning saying 145% tariffs is not sustainable in his interview with Time. Where does that leave us in these negotiations today?
Hi, Madison. Really hard to talk about this because the news is going to be changing every single day. The one thing we can say is that China is a very proud nation. They're still recovering from their century of humiliation. And over the last decade, they have really steered away their economy away from exports into domestic drivers, right? So what I can say is that I really believe that this escalation will come from the US. So it's going to be a US decision to start offering this off-ramp. And then I think hopefully it's in everyone's best interest to have this being de-escalated. What
is your percent assuredness that the U.S. is going to start that negotiation in earnest?
I think it's again, if you see the last communication from the president is that he's been very optimistic that he can find a deal. And I think that deal will start with the US, right? So maybe China can offer some symbolic wins to the US, but substantial concessions, I think, will need to start from the US side.
And talk to me about how you're seeing this playing out in markets, because obviously we're seeing investors seek safety outside of the US. Where are you seeing perhaps an opportunity that investors might be missing, an area of emerging markets that you're not seeing as much flow into than you might think is warranted?
I think overall, emerging markets are on sale, right? Emerging markets has always been cheaper than developed markets in general. But not only now emerging markets trading at around 12 times PE, which is dramatically lower from the US, which trades over 20 times, but also emerging markets be trading below the average of emerging markets, right? Which typically is around 13 to 14 times. So we see emerging markets in general on sale, but we see many cheap markets. So China is one that has been very cheap. Even India, where all the fundamentals are extremely positive, has derated as well, right? You have many stories in Latin America. Probably one that is totally overlooked is Chile, right? Chile has a very organized market and has been trading also at historical low valuations with very low interest rates and the potential for positive change on the political side, right? So across the board, we see many opportunities across many emerging markets. And I think finally investors are taking a look outside of the US, right?
Well, that's exactly where I want to go, Guy. I think you'll get a kick out of what some sources have told me is a total panic about whether or not US Treasuries are still safe, because there's just nothing like it. There's no safe haven like US Treasuries. And as an emerging markets expert, I imagine that you think there are other areas of safety globally. What would you say is the biggest potential hedge or safe area of investment in emerging markets right now?
I think for me, I go back to valuations, right? So when you have markets that are trading at historical lows, it's trading as low as they were trading during the great financial crisis in 2008. For me, that's the biggest safety you can find, right? So countries, you look for domestic stories in emerging markets, they're not exposed to US policy, and you try to leverage on the most powerful trend in emerging markets, which is the expansion of middle class. So you look at the US, you look at some other developed economies, middle class has been squeezed. And you take India, you take Saudi Arabia, you take many other examples in emerging markets where actually the middle class is expanding, right? So for me, this is the most powerful trend that you're going to have for many years that has been totally overlooked over the past 15 years since the advent of QE in the US. And I think for me, this is a safe bet. And that's where you can find great opportunities at very discounted valuations.
Talk to me about what you're looking at in terms of pension funds. Do you think that some of those, big potential whales in the room are interested in the Sell America trade? And are you seeing any activity indicating where they're heading?
The US still have a very vibrant economy. I think it's still going to be, you have amazing companies with winner-take-all type of business models that's still producing, outstanding profits. So it's still going to be the core of all the allocations. But at least I see most pension funds questioning now the narrowness of the US market and some of the high valuations and looking outside of the US. So I think it's a very positive for international flows and more specifically for emerging markets. We see most of our investors are pension plans in the US, and we see they're continuing to do more allocations outside of the US.
Guy, I want to end where we started, which is on, the trade war. There's this rhetoric that has gotten better, quote unquote, in the U.S. over the last week. This commentary about negotiations, Treasury Secretary Scott Bessent and the president saying 145% is just too high. But the actual policy, it hasn't changed over the course of this week. How optimistic are you about the rhetoric turning into actual policy short term?
I think I'm positive because I think it's no one's interest to have this effective trade embargo, right, between the two largest economies in the world. So I think cool heads will prevail. But again, I go back to the point that this will have to start with the US. Again, China may offer a symbolic win to the administration of the US, but the real substantial off-ramp needs to be offered by the US.
Guy, great to have you. Thank you so much. Hope you'll come back soon.
Pleasure.
Appreciate it.
Excellent.
Well, President Trump telling reporters today the U.S. is very close to a tariff deal with Japan. He also told Time magazine tariff deals should be wrapped up in the next 3 to 4 weeks and that the U.S. is negotiating with China. That comes even as China has denied the talks are happening. But when pressed on the timing of the talks with President Xi Jinping, Trump didn't want to say too much.
You said you spoke with President Xi. Have you spoken to him since the tariffs? When did you last speak with him?
I don't want to comment on that, but I've spoken to him many times.
Here with more analysis, Yahoo Finance senior columnist Rick Newman. And Rick, as you know, the president does tend to get more specific when he actually has had a conversation. What are you reading from this back and forth on whether or not there has been a conversation with Beijing?
I think I'm as skeptical as you sound, Maddie. So that sounded pretty evasive by Trump, and it sounded evasive in his interview with Time that was published earlier today. When he makes these broad statements, he could be referring to a conversation with Xi Jinping that he had in 2019. Yes, I've spoken with Xi. I think he did speak with Xi Jinping right after he took office a second time. That could be what he's referring to, having nothing to do with tariffs. So, all the latest signals are more of the usual. I mean, it sounds like a lot of bluster from Trump. He has backed himself into a corner in a way where he's basically laid down this red line and said all these horrendous tariffs, which basically mean we're not even going to get imports from China and from some other countries. These are all in place. And now all you trade partners, you have to now line up and come to me and offer to make some kind of deal. And as you've been pointing out, China is giving a totally different message. We're not lined up to go bend the knee to Trump in Washington, D.C. So honestly, I think it's just more confusion. I don't see anything that clarifies what's happening here at all.
So, Rick, where do you think this is heading? I mean, I know you read all of the research. You're obviously talking to people about this all the time. How much faith do you think there is out there that all this talk about triple-digit tariffs being bad from members of the administration is going to lead to a policy change?
We're going to end up with higher tariffs. I mean, the question is, do we get to a regime of higher taxes on imports in an orderly way or in a disorderly way? And, we're right on the cusp right now since April 2, Liberation Day, which some people call Ruination Day. We're right on the cusp between order and disorder, and Trump is playing this, very dangerous game with markets. I have no idea if it's going to end up orderly or disorderly, but it is going to, we are going to have higher taxes on imports. We're going to have higher costs on American businesses and consumers. We're going to have higher inflation than we would otherwise have. And we're going to have higher interest rates than we would otherwise have, and slower growth. I don't know if it's going to be a recession, but we're going to have a less vital economic situation than we had before these tariffs. And, just to go back to Trump's time interview, his whole policy is based on a fallacy, which is that our trade deficit means that other countries are taking money from us, which is not what trade is. But Trump is he's just a true believer in this, so we're going to have to suffer through it.
Rick, thank you so much. Great overview as always. Appreciate
Maddie.
it. Have a great weekend. We're going to have all your markets action ahead. Stick around for more. You're watching Catalysts. It's now time for some of today's trending tickers. This morning we're watching Phillips 66, Boston Beer, and Charter Communications. Joining me to discuss, we have our Yahoo Finance reporter, Josh Schafer. And Josh, first up, we are going to talk about Phillips 66 reporting a wider than expected loss after scheduled maintenance during the first quarter, hurting refining margins. The company expecting margins will improve throughout the rest of the year with the bulk of the turnaround effort complete. The earnings also coming as activist firm Elliott Investment Management has been pushing the refiner to sell or spin off its midstream business. A vote will be held at the company's annual meeting on May 21st. To me, the headline here is try not to have huge company changes happening amid a trade war you couldn't have predicted, because having those two pieces of uncertainty at the same time, maybe it attracts some activist investors and maybe it leads to some headwinds.
It's a tough spot to be in, right? And there's a lot of companies that we're talking about today in the last couple days really that are in that position, right? I'm thinking about Intel, which had poor earnings yesterday and is in the middle of a similar scenario, right? Where you have a lot of macro going on. And we're trying to turn around our business, and becomes a little tough, right? But I think the stock reaction here from Phillips 66 is kind of interesting too, right? To think about, you just said, not a great report. Stock's only down 2%, and I think this is one of those examples when you look at a stock that's down 20% over the last 6 months, it's down 10% year to date. Investors know that they're in a turnaround story. And I think we were speaking with Mark Newton from Fundstrat yesterday sort of about how do you deal with these companies right now? And he was talking about how you need incremental evidence that the turnaround is starting to happen, both in the stock market action itself and the stock price, but then also just in the story, right? And right now investors might be a little bit more cautious if you are a turnaround story to want to get into that name. You're looking at the chart on your screen there. There's a lot of charts that look like that in the market right now, but not every company is in the middle of trying to turn something around. So I think it perhaps makes it even slightly less attractive to some extent until you get incremental evidence that, again, okay, we did a lot of shifting around this quarter. That's what leads to our loss. How are you doing headed in the next quarter? When do I get that update? And then maybe you have more confidence coming in then.
Yeah, hopefully more confidence. I think that's what all of these companies want. But we're going to chat another ticker here. Boston Beer Company, producer of brands like Sam Adams, Angry Orchard, and Twisted Tea, topping expectations in its first quarter. The company attributed a 5.3% rise in shipment volume during the period to its Sun Cruiser, Hard Mountain Dew, and Twisted Tea brands. Boston Beer reiterating its full-year guidance, but did note the tariffs could impact its 2025 profit by up to $1.90 a share, or what could be between $20 and $30 million in cost. Really interesting to see that shipment increase. That seems to be the big headline coming out of this report. And also talking about 6.5% higher net revenue growth in the first quarter. Can they continue that momentum if there is a struggling macro environment?
As someone that's from Boston and loves beer, love talking about Boston beer every time.
Perfect.
That was why I wanted to talk about it. But this story to me is very interesting because Boston Beer is at an interesting point right now where they're trying to make this shift to Sun Cruiser, which is a hard iced tea vodka sort of mix and like that high noon-ish realm, right? And they had gone this route back a couple years when they had Truly. So Boston Beer also makes Truly, which is a White Claw competitor. They got way too much inventory. They weren't able to actually offload Truly because essentially the market moved too quick. People moved on from Truly and White Claw to High Noon and other options. And then you take a look at the long-term stock chart of Boston Beer. Over the last 5 years, that stock used to be over $1,000 per share.
That's crazy.
They had this, but they were trying to move on from beer, get other options, right? They had a lot of success with Angry Orchard. So Sun Cruiser, at least from the analyst perspective, seems to be that next move for Boston Beer. Okay, now we're getting into this ready-to-drink cocktail. Analysts said that it drove sales in this quarter. Obviously, that wasn't even the summer season. Seems to be more of a summer drink. So I think it will be a fun story to follow over the summer to see if that's kind of their after messing up truly a couple years ago,
Yeah.
if that's how they can get back into it and the stock starts to work again for those long-term investors. Because again, that chart over 5 years has not been great.
Yeah, we've got a bar owner coming on next week. Maybe we'll be able to ask, where's the kind of consumer demand story for,
What are they
for
drinking?
alcohol right now? What are people drinking? You know, what's the switch to cans looking like? We'll get to that story later. But finally, cable operator Charter Communications beating revenue expectations during its first quarter as strong mobile service growth offset losses in its video and internet units. The cable giant did manage to narrow those losses, shedding 181,000 video customers during the 3-month period. That's compared to a decline of over 400,000 customers in the same period a year ago. Again, adding more of those mobile subscribers than expected, which, by the way, follows suit with other cable companies like Comcast, which have been leaning into mobile services here, and also seeing that mobile is that driver of growth that is potentially a customer retention tool moving forward as well.
The mobile growth story is definitely interesting, right? Because it seems like just, again, you always wonder, where's your next revenue stream? How do we build off this customer that we already have and then get more sources of revenue from them rather than maybe attracting new customers, especially when you think about the cable space, right? Attracting new customers into cable right now is perhaps more challenging as people aren't really looking for cable, or some people in the younger generation might not be looking for cable. But how do we make more money off the traditional cable users that are going to stay with us for a long time? I don't think people really change their cable provider. I think once you're set in your house and you have Comcast or you have Charter Communications, you're probably just going to stick with it, right? So how do you then find another lever? And I think the mobile services industry seems to be an interesting growth story here.
You've never considered cable as a sports fan?
I don't have cable.
Yeah.
Not
like
a cable.
Some other
YouTube,
format.
YouTube TV.
YouTube TV. There you go.
It's basically cable. It's basically the same price, but it's technically not cable.
I think it's like a combo of 500 things in our household.
You get all of the cable products, and it's not that cheap, so it's basically cable.
There you go. There you go. Perfect. Cable is cable again. All right, Josh, thank you so much. To our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead, but stick around for more. You're watching Catalysts. Big tech stocks mixed to end the week after powering gains in the last several trading sessions. The relief rally coming after President Trump signaled that he could ease tariffs on China. Joining us now with more, John Chambers, JC2 Ventures founder and CEO, also former Cisco executive chairman and CEO, as well as Yahoo Finance executive editor, Brian Sozzi. Thank you so much for being here with us this morning, John. Talk to me about where the tech sector is heading this year. If we fast forward to Jan 1 of 2026, what are you telling me?
Well, I think we've seen during every opportunity and every challenges for the last 30 years, the tech sector always comes out on top. And I think the segment of the tech sector that ends up on top is the one that can be agile and flexible, both large companies and smaller. You saw that with Google's results, which were very solid. I think what that company's doing, and Thomas Kurian in particular, one of their top leaders, is doing with AI, is an example of that. So I think you'll see the tech sector on top in 26, 27, and 28. Brian, as we discussed before, it will be the decade of AI, and you will see literally deglobalization of the tech industry. We predicted that on your all show 3 years ago. You will see many of us, and I moved away from China 5 years ago, so I focused outside of China in terms of my key interests. But key takeaway here, bet on the tech sector every time. Will there be some train wrecks? Of course. But if you really look, AI will drive every company from a productivity, earnings perspective and drive our market and our standard of living.
John, always great to see you. Look, I put this question to Treasury Secretary Bessent last week on, can Apple make iPhones in the US and do it profitably and actually sell these things to consumers? He seems to think so, which I understand his position, but what say you? Can Apple move its production out of China? I mean, the company spent decades building it up there so they can profitably make an iPhone. Like, what does Tim Cook do, and can they make these products in the U.S.?
The answer is yes, yes, and yes. In terms of the approach, you just saw an announcement today about Apple saying they were going to be making iPhones in India. And if you look at the most strategic partnership to the U.S. over this next decade, it will be India. They tease about America and India being AI. Modi said that very directly in terms of the opportunity. So I think you will see iPhones being made in India, less in China, and you'll see iPhones being made in the U.S. and strike the balance on it. So I think this is one where you will see us get very close to key allies. I think the most important strategic partnership we have in the world is with India. And I think you'll see them lay the groundwork for a good working relationship in resolving the tariff issues effectively. So in your earlier comments, you talked about South Korea, a little bit about Japan. I'd really watch what occurs in India. They clearly would like to make this a win-win, and they've shown great flexibility. And our two leaders in India and the U.S. get along great.
John, you and I have been talking about India for, I would say, since 2014. I mean, you were early in that country, laying a lot of the tech infrastructure there when you were at Cisco. What would India getting Apple iPhone production mean for India? And then should investors think of India as the next China in terms of manufacturing?
I think investors should think of India as the next China in terms of outsourcing to manufacturing, but with a dramatic different relationship with the U.S. India and the U.S., the largest democracies, will get along great. They'll find a way, and we'll find a way to make it a win-win. If you look at the plan for the economy in India, it was driven by Prime Minister Modi, who's a good friend. And disclosure to your audience, I'm the chairman of the U.S.-India Strategic Partnership Forum. And Modi teases me about being his global ambassador. I had the honor to meet twice this week, earlier in the week, with the finance minister, Sitaraman, who's just amazing, very much focused on the partnership with the U.S., and she was headed to Washington to work on the trade agreements prior to the terrible events that occurred in India earlier. So I think you will see India become not just the most important U.S. ally, it will become the largest economy in the world over the next several decades. And I think U.S. and India will grow dramatically faster together than we can by ourselves. So outside of the U.S., my number one bet is on India. My number two bet is on India in terms of that part of the world.
John, it's a fascinating overview, obviously, given the expertise that you bring to the conversation. It does make me wonder how you're thinking about the United States' relationship with China right now. I keep saying every night I go to bed and President Trump has said he's spoken with Xi Jinping, and then I wake up and China says, no, we have not had conversations with the White House. Where does the China question mark leave you in terms of your outlook? Where do you see it heading?
It's a great question. In your all show 4 years ago, I shared with you that I'd encouraged all 25 of my startups, of which I have 11 unicorns, 3 companies have gone public, pretty good track record over the last 4 or 5 years. A little bit lucky, but I'll take that anytime. I was the original big high-tech backer and moving to China in 1995. First major decision I made as a CEO was to move my manufacturing to China. It was a win-win relationship. Under the current leadership, and beginning about 8 or 9 years ago, it became a win-lose at the expense of the U.S. And so that's when I quit investing in China, doubled down again on India, and focused on whoever leads in AI, and their associate alignments will occur. Will we eventually get back together? Yes, but I think it'll be a long, challenging direction on it. So yeah. I'm still giving the same direction to my startups. We're staying out of China. If I didn't already have a major presence there as a company, I would probably avoid it for the time being.
John, it's a fascinating answer, and especially given the market action right now. The big concern before these tariffs were even in the room was whether or not China was going to become the AI player of the world, obviously utilizing DeepSeek. We've heard news over the last week that they're utilizing DeepSeek in governments and hospitals. How do you weigh the risk of China's supremacy on AI versus some of the U.S. tech names having a longer runway?
Well, I think AI leadership, almost dominance, needs to be the top priority of the U.S. I'd like to see the administration and both political parties embrace that. I think we can get that leadership much quicker by working very, very closely with India, where they graduate 1.2 million engineers per year, and we only graduate 60,000. Most companies that I invest in have a major presence in the U.S. and India together in terms of the direction. I think China missed its window. 5 years ago, I would have said China was positioned to be the tech leader in the world. They took away innovation, started using their 5-year programs, of which I've seen 8 of the 14 occur, to say from a top perspective, here's how you're going to operate with innovation. And they took their leaders in tech and made them take a back seat. So I think they missed their window. I think if the U.S. and especially if the U.S. and India move well together, we will get that leadership. And you see a lot of that leadership in U.S. technology in India and diaspora and companies like Google, Microsoft, IBM, Adobe, et cetera. And out of my startups, probably half of them have founders that are part of the Indian diaspora. So I think we're going to lead in this. I think the economy's 2 to 3 decades out. Number one will be the U.S., and I think actually China missed that window in technology leadership as well. They'll be a tough competitor, but they don't play by the same rules. And so to me, trust is all about where you put your investments. That's based on track record, relationships, and trust implementation.
John, I've been surprised by some of the commentary from tech earnings this week. IBM didn't really sound like they're seeing a pullback in software demand. Heard the same thing from ServiceNow. Within your early stage tech companies, a lot of them focus on software. Are you seeing any pullback or slowdown demand?
I think the good news is I follow those numbers very closely, Brian, as you know, across all 24 of my startups. The minute the tariff issue was announced, in the next 24 years, we did a contingency planning across all of them. Classic prepare for a slowdown, but then position yourself for the upturn that follows it. I think you're going to see, Brian, that tech will emerge as the way you come through this transition, but you may see dramatic changes in which groups lead from tech. You mentioned 2 very good companies. What Arvind's doing at IBM, I think, is very creative. What Bill McDermott's doing at ServiceNow is very creative. We talked about Google earlier, Microsoft. In terms of my startups, the average one is growing over 40% year over year. We've not noticed a measurable change in orders, but the sales cycle is going out. It takes more signatures to get things approved. So we're anticipating that we could see demand in my startups, which are growing, let's say, at 40 or 50%, slow by 10 to 15%. And what we're doing is saying, what new things do you do creatively during this time in terms of geographies, industries, strategic partnerships to make this happen? All my companies now are AI. If you're a tech company and your foundation is in AI, you're probably going to be history. And will there be some misses on that? There absolutely will. But just to share numbers with you, a hot startup, Safe Securities, led by Saket Modi, he's growing year over year at 100%, 3 years in a row, and his headcount is decreased. They are driving productivity at 100% per year. If the U.S. businesses, regardless of whether a tech company, manufacturing, et cetera, drive productivity at 7 to 9%, and you bring that to the bottom line, you know what that means to stocks and multiples. So I think AI will drive this direction. Are we going to see a little bit of slowing in orders? I think realistically you will, especially the international orders where, there's a little bit of friction now between the various countries on trade. Yeah. I think we'll navigate through this. I'd watch the countries that you said earlier about getting a program here, but I think it would be unrealistic to think that we won't see a little bit of slowing in orders. And if you're going to see that, you've got to say, what are you going to do to increase your pipeline so that doesn't show up in your bottom line? Does that make sense?
It certainly does, John, giving us so many headlines for our audience to monitor amid a very uncertain situation. Thank you so much for making the time for us. And thank you, of course, to our executive editor, Brian Sozzi, for bringing us the conversation. Appreciate it.
It'll be an honor. 5 years in a row, we've called it right every year. Let's see how well we do together this year.
Hey, there we go. We'll have you back every year to monitor. Thank you so much, John. Appreciate it. For our audience, we're going to have all your markets action heads to stick around. We're checking in on healthcare stocks. The sector's been under pressure this year, facing headwinds on multiple fronts. Yahoo Finance senior health reporter Anjali Kemlani is here with the latest. So Anjali, outside of the pharmaceutical health stocks, which who knows what's going to happen with those sector-specific tariffs, what are the signals that Wall Street is kind of looking at in the sector?
Well, that's what they're looking for, is signals. And that's actually the reason why we're talking about this. We've seen, of course, that the pharma sector has been big on some of the uncertainty with tariffs and not knowing what is going to be impacting impacting them. But in the non-pharma sector, we're seeing a few signals for some interesting stocks. You're seeing pressure from the government, whether it is the tariffs or research funding cuts have been one of the big ones that are impacting both biotechs as well as clinical research organizations. I've been taking a look at some of those stocks and what it means for sort of the long term. We know biotechs have been under pressure for the last couple of years as interest from investors wane, and that's what's causing the volatility from the broader markets to really catch up to an area that had been kind of defensive for a while. You take a look at how the biotech sector has been stacking up. It's been kind of sad for them for a little bit. So take a look at one of the stocks I wanted to look at, MedPace, earlier this week. Really interesting numbers. They were a little softer on their earnings numbers, and so they got a lot of questions from the analysts on the call about what is happening for them. They are a clinical research organization, and so they help biotechs do a good job. You can see that huge dip that came up, and then now it's kind of trading flat and a little bit up since then, and that's because on the fundamentals, they recovered based on this is a cyclical kind of stock. Take a look at Intuitive Surgical. That's another area. So MedTech definitely getting hit by these tariffs. They were not carved out. And so it's forcing analysts to think a little bit more specifically about what goes into some of these devices, as well as how companies are thinking about these tariffs. You see the huge spike because the numbers looked good. They had a beat. And then questions about having to invest $2 billion, the impact on the company from the tariffs, and then looking to invest in manufacturing. So you can see that kind of volatility coming together, and it's making a really interesting earnings season for us and something we really need to continue watching.
It's fascinating, especially monitoring who's giving guidance, with how much confidence they're giving guidance, and saying essentially this could change at any second at the moment. Anjali,
pretty much.
Thank you so much. Really appreciate the overview there. Well, with tariff-fueled recession fears rising, which streaming stocks are built to last? Matthew Dolgan, he is Morningstar senior equity analyst. He's joining me now with two names he believes are best positioned to weather volatility. Thank you so much, Matthew, for being here with us. I want to start at Netflix, a stock that is at over $1,000 a share right now. Why is this a name that investors should consider getting into at that valuation, even amid some economic uncertainty to come?
Well, to be clear, we don't think actually that investors should be getting it at this valuation, but that's not to say that their results haven't been great and that we don't think that they are largely resistant to recessionary pressures. So if that's one's concern, and if they're thinking differently about us than us about the fair valuation, its business should remain strong. Our argument against it, again, is more based on valuation and the growth that it's pricing in. The results have remained fantastic. They reported last Thursday. The biggest thing there was the margin expansion. So they are just becoming more and more profitable, and that looks great. Underneath the numbers, there were things that made us less enthusiastic. And to get back to the recessionary point, Netflix, as well as Spotify, which I know we'll get to, are just very highly valued companies, big multiples on them. And so although we do think that their businesses are largely resistant to recessions or economic slowdowns, and certainly not too much tariff exposure, if growth slows a little bit, or if the market is looking to pay a little bit less in terms of multiples, that's where we think the risk is for these fantastic companies that I think got ahead of themselves on the stocks.
Right, I totally hear you. The valuation's gotten a little over its skis, but that doesn't negate the fact that it is a stock that tends to weather a slowdown. Talk to me about why that is. What is it about a company like Netflix that makes it that consumers aren't necessarily going to run out and cancel those subscriptions amid a slowdown?
Yeah, it's funny when you draw, I think about drawing a parallel to like a consumer staple, and really that is in many ways what Netflix is. I guess the ultimate point is consumers get a lot of value for their money. So not only does Netflix now in the US, as well as several countries, have the ad-supported tier, which in the US you can get for $7.99 a month, even the standard premium plan is $17.99 a month. And with all of the entertainment value that can provide, that actually is a very low amount. And so in a recessionary environment, when consumers need to cut their budgets in other places, they can find a lot bigger savings with other forms of entertainment and still pay, $10 to $20 a month and have all they want with Netflix. And so that's why we think it really is, for most consumers, among the last things that they'd be looking to cut out of their budgets from any sort of discretionary spending.
And is it a similar bull case when it comes to Spotify?
Yeah, for the operations, very similar. Consumers get a lot of value for the amount they pay. We actually think that a lot of these streaming services, Spotify, music streaming services, Spotify first and foremost, are underpriced relative to some video streaming services, considering all of the content that you get with them. You essentially have an entire music catalog of the history of the world, really. And so for the price you get, yes, it is a really low amount for a lot of enjoyment that consumers get. And Spotify, like Netflix, we think is the leader in its field and has consumers that are going to be very reluctant to get away from it.
Does Spotify win on a valuation basis, though?
No, it doesn't. And so both Netflix and Spotify, we think, are overvalued. And the reality is, and again, this is apart from any fears of an economic slowdown, is that we don't think either can really repeat what 2024 was. And we think that these stocks are kind of, if not pricing that in, pricing in something similar. 2024 was just a remarkable year for each of them, and the type of thing that it would not be reasonable to expect again, really.
So Matthew, help me understand then, like, who should be considering getting into these names? What type of demo should consider adding here?
Well,
no one?
I'm not saying that, but based on how we look at things at Morningstar with an intrinsic value and a long-term view, it would not be the type of stock, either of these, that I would recommend for those types of investors. For people looking to trade, which is not who we target ourselves towards, if you're trying to play less impact from tariffs or a slowdown and betting on continued good results quarter to quarter and the market staying excited, then these stocks can continue to run. But we think that at some point over the medium period of time, at least, there's going to be a pullback because of how expensive they are. And so for longer term investors, I guess those are the ones we would not recommend it for. For the others, I would let them take their chances.
All right, Matthew, thank you so much for the overview. Appreciate it.
Thank you.
Coming up, how one financial advisor is finding buying opportunities in this market. That when we come back. While U.S. markets have recovered some ground since the steep sell-off we saw in the days following President Trump's tariff announcement, all three major averages are still down year to date. Our next guest says investors should look at the volatility as a potential buying opportunity. I want to bring in Nora Youssef, RBC Wealth Management VP and Financial Advisor, for this week's FA Corner, brought to you by Capital Group. Nora, great to have you on here. Talk to me about the type of investor that should be essentially dip buying versus the type of investor that perhaps Bank of America's Michael Hartnett is speaking to when he says sell any rebound in this market.
Yes, well, I would not say to sell now while the market is down. And frankly, when the market is volatile, it is ripe for opportunity. And it's a matter of recognizing that when faced with uncertainty, earnings forecasts, headlines, markets tend to reprice to the worst case scenarios, which usually don't happen. And where we're starting with these tariffs is likely not going to be how we end. In fact, let's face it, the Republicans would get rolled in the midterms if this was 2026. So view this as a potential buying opportunity. Yes, it may feel unprecedented. Yes, it may feel like a new normal, but I urge you to seek out those opportunities because the market's the only place when the prices go down that people buy less. And it's times like this that serious money can be made.
So where is that potential opportunity? What sectors?
Well, I can't offer specific names, but just about every index and sector has pulled back, with the exception of REITs, consumer staples, utilities, which are defensive and not impacted by tariffs, and international. As for stocks, there are some really attractive valuations out there I haven't seen in a long, long time, with quality companies that have strong fundamentals and bode well with the long-term trends of AI. So don't overthink it, trying to catch the bottom or time the market. Just get in, and if you miss the 10 best days, which tend to happen within the two weeks of the worst 10 days, the S&P performance gets cut in half. So don't overthink it.
How much hedging should investors be doing then amid some of that volatility? I hear you saying, like, don't try to catch a falling knife, but then also get in at these levels when the market is on sale. Should investors be thinking, okay, well, if I do get in right now, maybe I should be getting in on some of those safer haven assets like gold, for example?
Yes, well, you want to seek, essentially you want to be a contrarian. The key to being a successful investor over time is being a contrarian. So really seeking out what is out of favor, as distasteful as that may seem at the time. And of course, this is assuming you have plenty of cash reserved in your emergency fund and you're in a position with plenty of dry powder to put to work into this market.
All right, Nora, thank you so much for joining us this morning. Really appreciate it. Have a great weekend. I want to do a final check on the markets here before we head to break, taking a look at the major averages. First, it's been very interesting to see the week. So first, we had 2 back-to-back days of 1% gains on your S&P 500, the first double days of 1% gains since the November 6th election. There was a question about whether or not that rallying was going to continue. Now you're seeing stocks just below the flat line. Of course, it'll be interesting to see whether or not we can rally into the close today, but we have seen a trend of investors going a bit risk off heading into the weekend. Interesting to see that you've got your tech-heavy NASDAQ here up about 0.3% as of this moment. I do want to flip the board, if we can, over to the bond market here, because it's interesting to see yields coming in just a touch. You've got your 10-year yield down about 3 basis points, hitting 4.28. Your 30-year yield down about 4 basis points. Michael Wilson earlier this week saying that if the 10-year were to hit 4.5, that could be a key risk for the broader stock market. Of course, we are not seeing those levels at this time, but then you got Bank of America's Michael Hartnett saying to sell any rebound within the market rally here. And finally, I do want to see if we can flip the board back over to those major averages, taking a look at the sector-specific action that we've got going on in your S&P 500 here. Some sectors moving to the downside, including real estate and utilities. Coming up, we got wealth dedicated to all of your personal finance needs. Brad Smith has you for the hour. Stay tuned.